Well, thank you. I'm delighted to be here. You know, as an economist, you're always delighted to be invited anywhere. We have a reputation to live down to, and we usually succeed in that effort. I appreciate your mentioning this book, The Age of Deleveraging. As a matter of fact, in our monthly newsletter that just came out for April, we updated this. Take a look back because we finished writing it literally 3 years ago. And where did we go right, where did we go wrong? And I mention this because if anyone would be interested in receiving a copy of this newsletter, all 52 pages of it, just give me your business card, we'll email you one. Be happy to give you that update. I'm going to talk about a number of these things, though, today, and what I'd like to do is outline a number of forces that I think are affecting the investment scene, and then come to our recommendations as to how you deal with this. The first one, where's the, okay. The first one is what I call the deleveraging, which is going on in the world. Now, this gives you a summary in the case of the U.S., but it really is universal. Here we're looking at the cumulative net outside financing of the 5 major sectors of the U.S. economy. In the case of the financial sector and the non-financial corporate sector, they issue both debt and equity. So this is looking at what is issued net of retirements, buybacks, et cetera. And all of these are in relation to GDP. The household sector and the 2 government sectors, of course, only issue debt. Now you see a number of interesting things from this, at least I think they're interesting. One is that the financial sector started to leverage up in the 1970s. They moved away from a fairly level relationship with GDP, and the household sector followed in the early 80s. That's when you saw leverage in Wall Street move from 20 times to 30 to 40 before they carried out Bear Stearns and Lehman. And in terms of households, that's when mortgage down payments went from 20% to 10 to 5 to 0 and even negative in some cases. The second thing is that deleveraging has started. In other words, you started to retrace this, move back to trend. I'm a strong believer in reversion to trend, but they're a long way from getting back there. Now you say, how long is it going to take, assuming we do get back to trend? I think we will. Well, normally, after a big build-up in leverage and a financial crisis, it takes about 10 years. And I'm using that as good an estimate as any. We're into it about 5 years now, started in 08. So I would say roughly another 5 years for this process to be completed. Now, during this time, in the household sector, you not only have the working down of debt, but you have the rise in the saving rate. And that reverses a very long trend the other way. 25 years, the saving rate in the U.S. was declining. It started at about 12% in the early 80s, got down to 1%. And what that said, that 0.5% decline in the saving rate per year on average, it said that the spending rate, that the spending out of after-tax income, which is the denominator, was growing about 0.5% faster than income itself during that period. In other words, this was a strong boost to the U.S. economy and to the global economy, because for every 1% increase in consumer spending in the U.S., our imports, the rest of the world's exports, increased 2.9%. That's just the historical average. So it really drove not only the U.S. economy, but I think most of the rest of the world, which basically is export dependent. That's particularly true in Asia, as you're all aware, not only China, but all the other Asian tigers and Japan as well. Now this looks like this too is reversing. It's very erratic because we've had tax cuts and rebates. People initially save them, then they spend later. More recently, we've had gyrations at the end of the year. Big dividend payments drove up the saving rate in anticipation of higher taxes with a fiscal cliff. And then you got the reverse side in January and February. But I think the trend is up. And this reversal in trend, going from probably a 1% increase per year, and I think we'll go back to double digits and away from a 0.5% decline, I think will really take about 1.5 percentage points off of GDP growth. And that would mean that from the growth rates in the 80s and 90s, 3.7% average real GDP growth, during those salad days from 1982 to 1990 that we'd be down to about 2.2. Well, you say, why is all this happening? Why are people reversing this? You know, it isn't by choice. I don't think a husband and wife wake up one morning and they say, dear, we've been spending too much, we've got to cut back. Oh, no, no, no. Americans are trained, and I mean, I use the word deliberately, they're trained to spend as long as there's financing. They're trained by the media, they're trained by the government, they're trained by lenders. I think it's only when they run out of money, and they've sucked all the money out of their houses with home equity loans and decline in house prices. People don't trust their stocks the way they did earlier to put the kids through college and take care of early retirement. The post-war babies have been notoriously poor savers, and they're now looking at retirement in the teeth or working until they drop dead at age 100. So you have a lot of incentives to save that are really forcing people to reverse this whole process. Well, I mentioned this in itself, I think, could knock 1.5% off of real GDP growth. And then you got a lot of other things coming in here. Things like increased government regulation, protectionism, clamping down on fiscal stimulus in developed countries. You got a lot of other factors that I think are entering the scene here. And so I come away, talked about in this book, and I think it's been borne out in the last 3 years, about 2% real GDP growth in the U.S. That's about what we've averaged so far in this recovery, and I think we'll continue at about that rate for the remainder of this deleveraging. Now, of course, this is a universal issue. It isn't in the U.S. We're seeing this slow growth certainly in Europe, where they had the misfortune to combine the Teutonic North with the Club Med South under one currency, but no common fiscal policy, and there's probably none possible given the huge cultural differences in Europe. You know, I think one of the ways of looking at Europe is a description of what heaven and hell are like in Europe. You know, in heaven, the cops are the English, the cooks are the French, the lovers are the Italians, and it's all organized by the Germans. Whereas in hell, the cops are the French, the cooks are the English, the lovers are the Germans, and the Italians organize the whole operation. Anyway, and of course we're having slower growth in China, and Japan has been limping along with 20 years of deflationary depression. So this whole thing is fairly universal. Now, of course, this huge deleveraging and the slow growth is not done unnoticed by governments. No, no, no. We've had huge monetary and fiscal stimuli as a reaction to this. And there is a fairly high correlation here, as you can see, between the quantitative easing and what it's done for stocks. And this is a universal thing. I'm using the U.S. here data. But every time you got a quantitative easing, QE1, then it ran until we got the Greek crisis in 2010, another quantitative easing 2, another crisis in Europe, and so on. It seems to give the economy, give the stock market rather, a boost until you get some kind of a shock. And I want to come back to that later in terms of what's going on now. Now, the point is here, you can't prove causality with statistics. I guarantee you absolutely positively every time there's a total eclipse of the drum, of the sun, if we go outside and beat a drum, it will go away. 100% correlation, but no causality. So what I'm saying is you can't really be 100% sure that just because stocks rallied with quantitative easing there is causal relationship, but I think it's logical that there probably is some involvement there. But in any event, what the Fed is trying to do is to improve the job market, and Bernanke talked about that again just yesterday, very concerned about it. But monetary policy is a very blunt instrument. It can't affect jobs directly. It's not like fiscal policy. If they want to help the unemployed, they just go out and increase unemployment benefits. But if you think about it, there are 5 steps between what the Fed does and job creation. And the Fed, unlike the European Central Bank, does have a dual mandate of full employment and inflation control. The first thing they do is they go out and they buy treasuries or mortgage-backed securities. The second thing is whoever sells them to them then goes out and reinvests, let's say in stocks. So third, stocks go up, they feel wealthier, real wealth effect. So then the idea is that they go out and they spend money on capital equipment or consumer goods or something, and that increases economic demand, and fifth, creates jobs. Now you got those 5 steps. And I think it's, again, you don't know what would have happened otherwise. There are no ifs in history. You know, history is not a controlled experiment. You can't change one baffle in the historical maze, run the rats through again and see which way they turn. No, no, no. History runs once. But it's probably better off than it would have been. But we haven't restored rapid growth, obviously in this process. And on top of that, this has been a very inefficient process. Normally, if the Fed gives the banks $1 in reserves, they, through lending it and relending it in a fractional reserve system that everybody remembers from their banking course, that turns into $70 of M2 money. That's simply the historic average, $70 of M2 for every dollar in reserves. Well, since the Fed started on this quantitative easing in August of 2008, they've gotten $1.8 in M2 money for every $1 in reserve creation, virtually nothing. What's happened to the rest? It's going into excess reserves, and you can see in this chart. If you look at the difference between total reserves and the required reserves, which is the bottom red line, it's about $1.6 trillion. That's the excess reserve problem. It's very inefficient, not working. And of course, it does leave the Fed with this big problem. What do they do with this eventually? How do they get rid of it? Are they going to simply let the portfolios run off? Are they going to risk some announcement or some leak down the road, and then the Treasury market collapses and we get a global recession? I mean, they've got a problem here, other central banks do, with these open-ended quantitative easing. It's new on the historic scene, and nobody really knows what's going to happen. Anyway, my first point here is that we do have this deleveraging. I think it is going to result in continuing slow growth. And the interesting thing about it is that the massive monetary and fiscal stimuli that we've had in response have not offset it. In other words, if you had this kind of monetary and fiscal stimuli in a normal economy, the economies of the world would be driven through the roof. We'd be at full employment, and so far we've had massive inflation with this much in the way of stimuli, but we haven't. So it shows to me the power of the deleveraging, that it is offsetting everything they've done in the monetary and fiscal arena. The second point is another reaction to this by governments. They've tried monetary and fiscal ease. That hasn't really gotten back to rapid growth. And they're getting desperate, and governments are under extreme power. We're seeing turnover in some of them, and threatened turnover in others, because they're not really getting the economy back on track. So one of the ways, as they're saying, is, well, if the domestic economy isn't growing that well, then what we need to do is improve our exports. Obama said 2 years ago we're going to double the exports from the U.S. in 5 years. Well, that's wonderful. Everybody says we're going to do that, and then the only question is export to whom? Who's going to buy? Who's going to be the buyer? Because the traditional buyers of the world's excess goods and services have been Europe and the U.S. And Europe is in a recession right now. It's deepening, and the U.S. has got slower growth. That game just isn't working anymore. So, but that doesn't mean that countries give up on exports. They just say we've got to figure out a way to make our exports more attractive. We've got to lower the price. So how do you do that? Well, one way you do that is internal devaluations. And you can see here in the case of the U.S., we've had declining real wages. That makes our exports cheaper. This is really as a result of, I'll come back to this later, of the tremendous cost cutting that's being done by American business and has driven profits in this recovery, because you haven't had volume expansion and no pricing power. But it does in effect make your goods cheaper in real terms. In Greece, their costs are down 1/3 from where they were when the crisis started. Greece can't devalue. They're part of the Eurozone. If they weren't, they would have devalued 2 or 3 times since the Eurozone was set up in 1999. Business as usual in a very inefficient, protected economy, but they can't do that. So you have internal devaluation. The French, now they're following the Germans. They didn't invent it, but they've come up with a really neat gimmick just a few months ago. They cut corporate taxes, and that meant that corporations had lower costs, so they could, in effect, lower their export prices. And then they turned around and made up the revenue loss from that by increasing the value-added tax. So they got 2 more kicks there, because value-added tax, as you're probably aware, can be added on imports, increasing the price, and subtracted on exports, decreasing the price. So they got a triple play out of that, internal devaluations. Now that isn't the end of the whole thing, of course, because there is then the explicit devaluations, and that's what the Japanese are involved in right now. Now, let me make one thing clear. Nobody ever institutes competitive devaluations. You never will hear a political leader say, we are competitively devaluing. No, 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 no. We're getting even. We're getting even. It's like the mafia, you know, they say, don't get mad, get even. That's what they're doing. You listen to what Abe, the new Prime Minister of Japan, and his finance minister are saying, at least in the English translations that I've read, and they're saying very explicitly, they're saying the ECB and the Fed flooding the world with money, and that money has basically pushed up the yen in relation to the euro and the dollar. And we're going to get even. We're going to get even. So, and they're also trying to get out of the deflationary funk, and they are pushing the economy, and you can see there what is happening recently. The yen is going up here, more yen per dollar weakening against the dollar as a result of really more on the come than actual efforts, although recently the Bank of Japan program last week, I'm sure you're aware of, was really massive. They're buying 40-year Japanese bonds. They're doubling their purchases of bonds. They're really trying to pour money into that economy and to hope to get out of this mess. Now let me just say that, and of course what's happened is that spilled over to stocks because it makes their exporters more competitive. Now just a couple of quick points on that. One is, we work with a number of hedge funds, and some of them about 2 weeks ago bailed out of positions that we have in our portfolios, and we continue to have, by the way, short yen and long Japanese stocks. And the reason they did that, they say, I've seen this movie before and it ends badly. They've seen numerous Japanese governments in the past come in with programs of big stimulus, and within a few months they faded. And they're saying that's what's going to happen this time. And that, in fact, is true, because what happens in Japan is that they change governments. I think there have been 5 prime ministers in the last 4 years. But Japan, unlike Italy, for example, that has the same thing, but usually pretty chaotic, Japan has this very, very strong professional bureaucracy that basically runs the government, so the prime ministers can come and go, no big deal. The problem is that that bureaucracy is very conservative, and it tends to overwhelm these new programs. The prime minister comes in, we're really going to stimulate this economy. First thing you know, they start out with an approval rating in the 60s, and in a couple of months it's down to hat size, and the bureaucracy says, well, this guy hasn't really got any public backing, and they take over, and the whole program gets wiped out. The reason that I think this one may have legs is because Abe's approval rating started out high, and it's increased. It's now 71, is the latest reading I saw. And I think as long as that approval rating stays high, it means that he's got the backing of the voters, that he can roll over the bureaucrats, and I think he did that with the central bank head choice and the program that was announced last week. Now, the other thing I would mention about this is that this doesn't go unnoticed by the rest of the world, and particularly in Asia, where these countries are all competing fiercely for a shrinking export market. And you look at Korea, Indonesia, Taiwan, all of these countries, and they really feel the effects. If Japan is getting more competitive, they have the tremendous urge to join in. And I think what happens is, at the end of the day, is you will get more competitive devaluations, and they probably will be net against the U.S. dollar. The U.S. dollar is the international standard. I think will probably be the one that everybody, in effect, ends up devaluing against. So I look for a strong dollar coming out of that, as I'll mention later. Okay, the third force that I want to mention is what I call the grand disconnect. And this is this vast gulf that continues to be wide and even opens between the economies on the ground, which are basically limping along. You know, Japan is basically going nowhere in its economy. Europe is in a deepening recession. UK is back in recession. U.S. growth barely limping along. You look at all these economies, and China's slowing growth. Nothing much happening there, but investors couldn't care less. As long as the central banks are shoveling money out the door, that's all they care about. Don't fight the Fed. So you see the tremendous zeal for, particularly for stocks. And this chart, I think, illustrates it, because you can see the Fed's balance sheet, the red line, and nothing was happening there, growing very slowly until August of 2008, and then the big quantitative easing started, and the top line there is the S&P, no correlation. But boy, since there has been, they've been following each other in lockstep. And I think that's where we stand right now. And we're seeing this really on a global basis. You can see here a number of stock exchanges, the S&P, the FTSE, the stocks, the Nikkei. They all pretty much responding to the same thing. And then you look at even Greece. Greece was the best performing stock market in Europe last year, starting from a very low base, of course. But this is a universal phenomenon, this idea of central bank largesse and this grand disconnect. Now, I don't think that's sustainable. I don't think it can last forever. And I think at some point we'll probably have a shock which will reconnect it. And you pick the shock, a blow up in the Middle East, a spike in oil prices, some serious problem with North Korea, you know, pick whatever you want, but I think just like in the past, as I showed when we had these crises in Europe, they did seem to draw an end to the stock reaction to the quantitative easing that we've had earlier. But in any event, closely allied to this grand disconnect is the fourth factor I think is affecting markets, and that is the zeal for yield. With low interest rates, of course, investors are saying, you know, I really got to have more yield, and I'm going to forget about risk. And so you see here, as just an example of what's going on, the declining yields on junk bonds and the narrowing spread versus treasuries. And of course, you see the same thing with emerging market debt. You see it with leveraged loans. It's been a zeal for yield, and what's fascinating is that it has gotten to the point now where a number of investors are saying, gosh, maybe I'm better off in stocks. Here you can see that AA corporate yields are actually below the dividend yield on the S&P 500. And individual investors particularly have been moving into stocks starting at the end of last year in the U.S. And that's a big break because from 2007 on, starting in 2008, they were systematically selling U.S. equity mutual funds and buying bond funds. And now they have really moved back into stocks just very, very recently. Fifth force that I think is at work here is this is the end of this growth by exports that I touched on earlier. If you look at China in particular, China had a marvelous export machine that was rolling right up to the recession starting at the end of '07. Basically, the economy was driven by exports and the capital equipment and infrastructure that produced those exports. And the consumer, well, they probably thought they'd get around to helping the consumer at some point, but not important. And consumer spending in China is just such a small percentage of GDP. It's 37.7% of GDP is consumer spending in China. In India, it's 56%. In Europe, it tends to be around high 50s. UK, it's 66. The US is 71. China is off the map here. And I think the leaders were caught flat-footed by the global recession and by the collapse in U.S. consumers who ended up buying a lot of those exports. So they're in the process of trying to reorient that economy toward a more internally driven economy. And these are smart guys, but it's a long project. It's probably a 10-year project. I mean, the saving rate, the household saving rate in China is close to 30%. Why? Because people need to save. It's a Confucian society. They want to take care of their families, but they also have no equivalent of Social Security or Medicare, health care, so they need to save for those things. So the government has to step in and provide those. I mean, there's a lot of things that need to be done there, and then they probably will. But then, you know, there are problems. They say, well, increase wages, and that'll give more purchasing power. But then the exporters say, yeah, but you're driving our business away. And a lot of the low-end manufacturing, of course, is going to Vietnam and Bangladesh and Pakistan, and the Chinese are moving up the scale of sophistication. That's normal in developing countries, but it isn't an easy transition. And if you look at commodities as a reflection of this end of this export game, I think that it's no coincidence that this commodity bubble, and I think it was a bubble, started early in 2002 because China joined the World Trade Center at the end of 2001. And everybody has adopted the attitude of commodities are really what China is going to own, all of them in the world. And they do, in effect, account for over 40% of the world's take of, on an annual basis, of copper, tin, lead, zinc, the non-ferrous metals. They're buying agricultural products, they're stockpiling crude oil and so on. A lot of their numbers you can't trust, or they don't publish them. But the point is that they have done this, and the fact that manufacturing has shifted from North America and Europe to China magnifies the effect. It makes them look a lot bigger than they are as a domestic economy. In any event, as you notice there, commodities, they had to run up, they collapsed with a world recession, came back, but they've been declining since the beginning of 2011. And I think that's reflecting a slowdown in China and indeed the world. And I rather suspect that the commodity bubble was over. And it was a bubble when you look at all the money that went into exchange-traded funds and mutual funds that were commodity-related. You look at pension funds. We work with a number of state pension funds who now regard commodities as an asset class. And I say, no, commodities aren't an asset class, they're speculation. I mean, we're involved in our portfolios, our aggressive portfolios, but they're not an asset class in my view. But they regard them as that. And the one thing that I would point out on commodities is, in a long-run sense, commodities are not a very good investment. This is looking at commodity prices deflated by the CPI going back to 1774. Now, I don't know about 1773, but from 1774, you can see the history. What's interesting is that from the mid-1800s on, they've been in a declining trend. And that to me is fascinating because the U.S. really hit its stride in terms of the Industrial Revolution after the Civil War in the latter half of the 1800s. And that was a huge user of commodities. And then Japan went through forced industrialization in the latter decades of the 19th century. Again, huge users of commodities, and yet the prices were declining. Now you see interruptions, the Civil War, World War I, World War II, then you see the oil embargo in the 70s, but they don't last very long. And what this chart really tells me is that human ingenuity beats shortages any day. And I know all the arguments for commodities. There's only so much copper in the crust of the earth. And there's all these increasing billions of mouths to feed, and people are upgrading diets, and when you eat meat as opposed to grain, the animals don't translate 100% of the corn you feed the chickens into a pound of chicken. So, I know all those arguments, sure. But all I'm saying is, Malthus, a lot of people still believe in them. I don't, because I don't think history supports that. And I think commodities, in a long-term sense, and you look at this commodity bubble, suppose we've had in the last decade, right at the end, what did it do? It basically kept commodities flat in real terms. The sixth thing, force that I want to mention is what I think is a vulnerability of stocks, and I'm concentrating here on developed countries and talk specifically about the U.S. I mentioned earlier that American business had been cutting costs. That's why, main reason why real wages have been declining. And you can see the results here. These are shares of national income, which is kind of like GDP, only it looks at it from the basis of who gets the income as opposed to who accounts for the spending. It's the other side of the double entry bookkeeping system. And what you notice there, a mirror image between profit share, which is the right-hand scale, and labor compensation left-hand scale. Now, profits are now at an all-time high in terms of share of national. This is, in effect, a nationwide profit margin measure. And it really has been because of this cost cutting, and American business in this recovery has not had the volume increases. They haven't had the pricing power, so they've cut costs. And that worked tremendously, but there are two problems with that. One is that in a democracy, I don't think you see one hand, either labor or capital, getting the upper hand indefinitely. And if you look at what the administration is doing in the U.S., I don't think that the President Obama gets with his advisors and looks at this chart and says, hey, we got to correct this, that's our mission. But that's what they're trying to do. They're trying, in effect, to move money out of the hands of higher income people and corporations into lower income people's hands. And they're really trying to say we've got to rebalance if they were to look at it in these terms. The other reason is that the ability to cut costs is no longer what it used to be. If you look back in 09, 010, productivity growth in the U.S. was very, very strong with cost cutting. Recently, it's been much more erratic. And so unit labor costs, which are very highly correlated with profit margins, which were declining, no longer are. Now, I talk to industrial clients and I say, what's going on? Have you run out of cost-cutting opportunities? They say, no, there's always room to cut costs. But they've either scraping the bottom of the barrel or they've picked all the low-hanging fruit. They got to wait for more to ripen. Something's happening. They're not getting that. So I think those margins are vulnerable. Second thing to note about this is a longer-term look at PEs. This is Bob Schiller at Yale, a good friend of mine. He uses a 10-year moving average of earnings to iron out the cyclicality in terms of looking at the PE. And you notice there the long-term average of 16.5. Now, you can say this time it's different, although Sir John Templeton said those are the most dangerous words in the English language. But if you believe that that average is valid, then you would say stocks are 25% overvalued. That's what it would take to bring that PE back to that 16.5. And you also would note that in the last decade, it's spent a lot of time above that average. So if it's going to equal that average long run, you would expect it to spend time below that. And that brings me to the next aspect of this, which is what kind of a stock market are we in? I think we're in a secular bear market that really started in 2000. And secular bull and secular bear markets very much reflect the economy, as you would expect. Whereas we had very rapid growth from 1982 to 1990, that's when inflation was coming down, interest rates were coming down, American corporations were restructuring. It was a golden age in retrospect. Of course, you only know golden ages in retrospect. At the time, you don't say this is a golden age. But in any event, that was the case. But since 2000, we've had all these corrections, and we had, of course, a housing bubble that sort of temporarily clouded the thing. But you can see here that if you look at the S&P in inflation-adjusted terms, there really has been a declining trend, lower lows, lower highs ever since in a secular bear market. And I say it does reflect the economy. The growth in the economy since 2000 has been it's been less than 2% annual rate of real GDP growth. And of course, the stocks reflect the economy with the addition of PEs, and PEs go up in secular bull markets. They go from high single digits to usually around 20. It got to 26 in 2000 on the S&P 500, and then they go back to single digits in secular bear markets. So you get a magnifying of the economy in stocks because of the PE play. Here's a longer run look at secular bulls and bears, in effect using inflation adjusted numbers. Now, the final force that I want to mention here is one that is in the title of this book, Investment Strategies for a Decade of Slow Growth and Deflation. Not many people believe in deflation, but I think there is a case to be made. And deflation is basically a period of excess supply relative to demand. And in terms of money being the cause of it, as Milton Friedman said, yeah, maybe, but when you've got basically the situation now where nobody wants to borrow and the banks don't want to lend, I don't think money is terribly relevant. Now again, when the economy picks up, if all those excess reserves are still there, that's another issue. But in the meanwhile, if you look at this chart, this is simply dividing all the years since 1749 into peacetime and wartime. And then you'll see in the lower right-hand corner the averages. Wartime inflation averaged 5.72%, and in peacetime it was negative 1.16. Peacetime is a period of deflation in the U.S. Wartime is when the government is spending more than its share on top of a fully employed economy, and you get the excess demand and inflation. But in peacetime, you tend to have the kind of productivity growth and so on that does promote deflation. And I think that that's probably the case. Okay, now with those 7 forces, let me move on to our investment strategies. First of all, these are the things that I think are attractive in the long run. And I'll make further comments on these with some further sides. Treasuries I'll come back to, income producing securities. This is really a safe haven, economic weakness, possible deflation, which would drive these. Foods and staples, consumer staples in a low growth environment, I think they're attractive. Small luxuries, these are the things that people want to buy. They want the best of what they can afford. Maybe it's a high priced imported beer, liquor, maybe it's something, a pair of cufflinks that come in a distinctive blue box, that kind of thing. US dollar as a safe haven. I mentioned the yen already, and I think the euro is going to follow in that vein. Of rental apartments, they're probably overbuilt. I'm probably not going to pursue that one further. Healthcare, we'll come back to. This is the retiring post-war babies, et cetera. Productivity enhancers. This is really this is a cost cutting. I think a lot of the capital spending we've seen so far and will, as long as you have excess capacity, be aimed at productivity enhancement, not more capacity. And North American energy, this is really the idea that I think the U.S. in particular has decided as a nation that we want less, that we simply want less dependence on imported energy from unreliable areas like Venezuela, Africa, the Middle East, Russia, and so on. Well, just some comments about some of these individually. This is probably my all-time favorite chart because I was lucky enough to participate in this starting back in 1981. This is, at that point, the long bond, the 30-year Treasury, had a yield of 15.21%. And I was convinced that inflation was unwinding, and therefore there was going to be a big rally in bonds. And I said in print in 1981, we're entering the bond rally of a lifetime. Now this is showing one way of looking at this. Here we're using 25-year zero coupon treasuries. The data was available for the 25-year. And we're assuming that you roll these over every year to maintain the maturity or the duration, which of course for a zero are the same. And we assume that you bought them in October of 1981, which was the low in price, the high in yield. And you can see where you are now. And in contrast, if you bought the S&P 500 at its low in July of 1982, and on a total return basis, you look where you are, and the bonds have outperformed the stocks by 7.6 times, 7.6 times. And I assure you that treasuries are only suitable for little old ladies and orphans. Now, let me say this. I have never bought treasuries for yield. I couldn't care less what the yield is as long as it's going down. And I happen to think now people say 3%. Why would you buy a treasury at 3%? Well, that's like saying why would you buy a stock with a dividend yield of 2%? You don't buy it for 2%. Most people don't. They're looking for appreciation. The same with treasuries. And I think that we could go to 2% from 3% on the 30-year bond, and if you do on a zero, you make a capital gain of 32%. The dividend stocks, I mentioned those too, and I think the pressure is on for dividends. Investors after the bloodbath of 08 said, hey, we want some money here and now. We don't want to wait for capital gains out in the wild blue yonder. And dividend yields, they used to be a floor of 3%, and the payout ratio averaged 50%. I think we're probably going to go back to those numbers, at least because of pressure from stockholders. So dividend-paying stocks are, to me, attractive. The dollar I mentioned, you can see the euro is working down. I think that will continue. We probably could get to par, 1-to-1 dollar-euro before this whole thing is over. I'm going to skip over these housing, as I say. I think that is getting overbuilt. But just a couple of points on health care. You can see the health care as a percentage of GDP in the U.S. Now, we have a different health care system than you do in Canada. I'm well aware of that. And we have one that's designed to be the most expensive you could possibly come up with. And I'll give you 3 reasons for that. One is that very few people pay out of their pocket directly for health care. It's either government or employer insurance, or even if they have their own insurance policy, once you pay the premium, you want to get the full benefit. You want to get all the goodies you can. Secondly, you have all this new technology. Now, maybe it means that it'll prolong life another 2 weeks at the end and cost $100,000, but hey, it's my life, it's your life, the best is none too good. And the third reason is that we pay per procedure, and that encourages medical providers to perform more procedures, more operations, et cetera. So you have that, and of course you have on top of that, you have the post-war babies, the demand that they're going to come up with, and also we're going to have 31 million more Americans covered by health insurance. I mentioned briefly about North American energy, and here you can see the imports, the percentage of supply. It's declining, and you can see North America is lower than just the U.S. I think that we may see self-sufficiency in North America. I doubt it'll be in the U.S. for many, many decades, but maybe North America. And finally, here's my list of things that I would sell or avoid. Big-ticket consumer purchases, because I think that consumers are going to retrench. Credit cards fall into that. Conventional home builders. There, I think that people are more interested in renting now. They realize house prices can and do fall. They can't qualify on credit scores and so on. Banks are under real pressure to delever. Basel III requirements, regulatory tightening. They're being busted back to spread lending and away from all the profitable proprietary trading, off-balance sheet activities, and so on. Junk securities, I think defaults will raise their ugly head. Commodities, we talk about, supply exceeding demand, and developing country stocks and bonds. So that's pretty much the list of what I've got on the long and short side. It, I think, follows logically from the 7 basic forces that I laid out. And of course, there is that slim, inconsequential, remote possibility I'm dead wrong, and things turn out very differently, but I hope I can come back later and tell you why I went wrong. Thank you very much.
Thank you very much, Dr. Shilling. Because of time constraints, we only have time for 2 questions. Okay, 2 questions. Anybody who's going to ask a question? There's 2 mics, one from there, and what are the mics, the mobile mics? Is there another one on the other end? Over here. What is the...
Do we have a mic over here?
There are 2 mics, right?
Do we have a mic over here? Yeah. Gentleman over here.
I had a question in regards to the, your recommendation of U.S. energy, and that seems to be, I don't know, necessarily a conflict, but how do you reconcile that with your view on deflating values of commodities? I mean, is that...
Yeah, that's a good point, and I think that it probably is more in the production end than the price end. Now, in terms of commodities, of course, the biggest new development has been shale oil and gas. Gas probably more than oil, but tremendous flooding of the market, collapse in gas prices. You got from $13 an MCF down to $2. We're about 4 now, but and shale oil I think that I wouldn't bet on the prices, but I think that the production is going to increase one way or the other, because there's just going to be a lot more emphasis on this. Now, there are a lot of things that have to fall into place. One is the Keystone XL pipeline, which the administration looks like they may approve now. The State Department has said okay, and Nebraska, their regulators, their environmentalists said okay. But I think there probably is going to be development of more North American energy, but I would look more to the oil service areas and the business of producing it, as opposed to betting on the price. Now the 2 are related, obviously. You look at what's happening on the excuse me. You look what's happening for Fort McMurray, and the price of oil does have something to do with how much activity is going on there. But I do think there is probably overriding the general weakness in commodities, this zeal for more self-sufficiency.
One more? Okay, great. There's one.
Perhaps I can speak loudly enough not to use the mic.
I can hear you.
Okay, John Anderson. You mentioned another 5 years of deleveraging.
Yes, sir.
That is taking money off the market. Do you see interest rates remaining pretty flat through that period, or are you looking at something else?
Yes, I think interest rates will remain low as long as this deleveraging is underway. And of course, Bernanke, who has been the chief architect of this at the Fed, probably is going to leave next year when his term as chairman expires. But he in particular has been vehement on this idea, and he is when he was a professor at Princeton, he was a great student of the Depression and felt very strongly that the Fed raised rates prematurely in 1936. You know, the Fed and FDR worried about the recurrence of inflation. Now, prices hadn't even gotten back to 1929 levels. They were rising after 33, but they're still very depressed. But they worried about that. They tightened monetary and fiscal policy. The 1937-38 recession resulted, it was more than twice as severe as the one we just went through. It was called at the time the Roosevelt Depression. And Bernanke, he cites that in many of his comments and speeches, and as an example of what they don't want to pursue. So now, again, he's not going to be around for 5 years in all likelihood, but I do think that there is this feeling that as long as the economies are weak, that they'll continue this pressure to hold down interest rates.